Are you planning to buy a new home? If so, this video could save you thousands, even tens of thousands of dollars. It's a long video, but we're going to cover so much. In particular, we're going to cover how to exploit today's market conditions here in California. Number two, how to leverage your lender. There's amazing capabilities that lenders can help you be in a more powerful position as a buyer. We're going to discuss that. And number three, how to select a strong agent and what you should be looking for. So my name is Patrick. I am a real estate agent here in Orange County, California. So I earn my living by helping people like you buy and sell property, buy and sell homes. So let's get started with today's content. So number one, how do we exploit today's marketplace? And the reality is that the market has changed. We've had some fundamental changes in the marketplace over the past, say, 18 months or so. And most homeowners and most real estate agents really have not adjusted yet. So the reality is that the inventory levels, the amount of properties that are on the market available for sale has gone up dramatically over the last 3 years. Like it's more than double what it was in 2022, right after the pandemic. So there's a lot more in inventory than there used to be. And that's awesome news for buyers, obviously. So for you as a buyer, for the first time in a long time, you actually have some selection. You have a little bit of negotiation power. So it's really been good news. But the agents in the industry really are stuck in the past and they are catering to sellers who haven't yet appreciated or embraced the new realities of the market. So a lot of the properties that are on the market today, frankly, are overpriced. They're overpriced. People have an unrealistic expectation. So we have this bifurcated market where there's some properties, it's a minority that are priced well, priced competitively and marketed well. That's very important, actually. And they sell very quickly. But the majority, more than half, like three-quarters of the property, are overpriced and they're not marketed well. And so they're sitting on the market. Like three-quarters of the property are sitting on the market. And so what it looks like essentially is the green line here is if it's priced correctly. So you have a lot of showings on the first week, the second week, there's a lot of excitement, a lot of buzz. And ideally, you want the house to sell really in the first 2 weeks, maybe 3 weeks. You want it to be gone. But the reality today, in many cases, is the orange line where these properties are overpriced. And so there isn't a lot of activity out of the gate, which is a huge problem because they're missing the whole opportunity. Because in real estate, all of the activity when a new property hits the market, it all happens in the first 10 days. Really, the first 2 weeks, 14 days, that's when all the excitement, all the activity happens on a new listing. So if you miss that window, you've really missed the whole opportunity of putting a house on the market. And that's what happens when you overprice the property. And so many properties are in that situation today. But the good news is that this creates an opportunity for buyers because a lot of these properties, they're in this situation over here where these sellers are desperate. They've had to lower price at some point along the way to try and get new interest in the property. But people, when they look at it on the MLS, it's been on the market for too long, so it kind of becomes toxic. And so all of a sudden, these sellers have a huge problem on their hands. That's the problem of overpricing properties, by the way. But it creates an opportunity for us as buyers to come in and have a lot more negotiation power to bid low and get some great deals in real estate. So one of the first things we're going to do together, if we work together to buy a property, is sit down and figure out what specifically are you looking for in a piece of property. And there's a whole series of questions that I need to get through to establish that. But once I have that information, I'm going to pull the entire inventory of all the properties that fit the basic criteria, the basic characteristics of what it is you're looking for. Like maybe it's 4 bedrooms, 2 bath, or maybe it's a certain square footage, or maybe it's the layout, one level versus 2 levels, and so on. But I'm going to pull all the properties that fit that criteria. And then we're going to look at it together. And by the way, if you're looking at this screen, it's an Excel spreadsheet. If your eyes glaze over, don't worry. Like you don't have, this is my job. This is what I do on the back end. I'm just describing it for you so you understand where the opportunities are to get a great deal. But when we have this inventory, we can sort the properties based on price per square foot, right? But then on top of that, we can also look at the price per square foot of the lot size At the end of the day, you're buying land, right? And so if you get a bigger lot, you're getting more land. That's worth a lot. And so I pull both. And then what I do is I actually add the two of them together, which creates this column that I just hired in green that says price per both. So it's essentially a combined figure that incorporates both price per square foot of the structure, the living space, and also price per square foot of the lot size. So you put those together, and the number is kind of arbitrary, but it's a great way for us to compare different properties and see where the value is, which listings have a lot of value. And then the other thing I want to point out here is the far right column. Where the heading is blocked by the video feed of me here, but it says DOM there. DOM stands for days on market. And I've highlighted all the properties that have been on the market for 40 days or longer, because that's those sellers that I just mentioned a second ago that are kind of in a bind and they're generally desperate. There's an opportunity there. Now, obviously, some properties have been on the market for such a long time. Like this one here, 349 days. This is a huge problem. And lower on the page, you've got 247, and then even this one, 174. This is a between the owner of the property and the real estate agent, they have a very unrealistic expectation of what they're going to get for this property. I blame the real estate agent. So those properties, there probably is a legitimate problem with those properties, but some of the other ones, they're just overpriced. They're probably great properties, they're just overpriced. And so we should look at those properties as well, right? These are the ones that are in that situation. They've been sitting for a while. And so there's a negotiation opportunity for us as buyers to get a great deal on those properties. Now, the problem is that those properties don't host open houses anymore. Generally when a listing hits the market, you're going to do an open house that first weekend for sure, the second weekend for sure, probably on the third weekend. But already by the fourth and fifth weekend, it starts to fall off. And these agents don't host open houses as much. And so you can't really see those properties by doing the normal tour, on the weekend open houses where you're going from one open house to the other and you see the same people at each property. Honestly, it's a very inefficient way to look at properties because you're missing all those properties that have been sitting for a while. So what you need is to actually make private bookings, private showings. That's what I do as an agent. This is actually one of my primary activities is to make appointments to show property where they're probably not hosting open houses. So it gives us, and we can figure out exactly the ones that you're interested in that fit your criteria. You've looked at the photos online. It fits what you need. It fits what you want. And we can, visit 4 or 5, even 6 of them in one day. And it doesn't have to be on a Saturday or a Sunday. I mean, it can be, but it can be on a Tuesday. It can be on a Thursday. It doesn't matter. And we can visit these properties. We can knock out 5 or 6 in a single day. That's the most efficient way to look at real estate, right? It's kind of like a treasure hunt. You're going out and seeing, okay, what can we find here? Where's the opportunity with some of these properties, particularly the ones that have been sitting for a little while. So that's an opportunity that we can take advantage of. It's a treasure hunt. It's fun. It's actually my favorite part of being a real estate agent. So now we have to look at the 25% as well. Like we just talked about the 75%, the 3/4 of the properties currently which are sitting on the market for too long. But we want to look at the 25% also. And those properties are selling quickly. So there's a lot of turnover. Every week there's new properties. And some of those properties are priced well and marketed well. And they go really quickly. And so we want to stay on top of that as well. And you're probably using websites like Redfin and Zillow. And these are extraordinary websites. It's amazing that these platforms exist. And, as a member of the public, you have access to all of this information. It's spectacular, but it's not as detailed and as accurate as you might think. So there's a lot of programs, these platforms, Zillow, Redfin, these are pay to play websites where agents pay money, a lot of money in some cases, to feature their listings. And so when you search for properties on these websites, in many cases, you're seeing the featured properties first. And to get to all the detail that you would get on the MLS, for example, you might not have access to that on Zillow. So this is the actual back end of the MLS. So the MLS is an unbelievably powerful piece of software essentially. And I pay $170 a month, if you're curious, for access to the MLS. But there's so much detail. Like, look at all these different criteria. And this goes on and on. I just showed you one screen chat. Here's another portion of the search criteria. Here's another section. So we can get really granular on the specific things that you're looking for in a piece of property. And that's what actually leads to this inventory, is using the MLS. I pull that information directly from the MLS. So now we have an opportunity to see the 75%, the three quarters that are sitting too long, right? And we also are seeing the 25% that are marketed well, marketed aggressively, priced well, and they're going to sell quickly, right? So we're seeing the entire market. Now, if you're curious, the average person visits 7 properties before they put an offer in on a house. With me, it's actually higher than that. I'm closer to like 11 or 12, but that's because I'm such a big proponent. I really believe that you should see as many properties as possible. I want you to see the whole inventory before you make a decision, because there's all kinds of treasures that we can find together. So another opportunity are the off-market properties. So a lot of people sell their house off market. They call it a pocket listing, if you're curious. In the industry, it's called a pocket listing. But they market off, they sell their properties off market because they want to protect their privacy. So they, for whatever reason, they don't want their house to be on the MLS and then it ends up on Zillow and Redfin. They don't want that. And so they do an off market sale. And honestly, it's not a good deal for sellers. The average off-market property, statistically, like they study all these things, the average off-market property sells for 4% less than the equivalent properties that are on the MLS. So they're not necessarily getting a great deal. But again, that's an opportunity for you as a buyer. So if we're working together to buy a house, we should look at the off-market properties, because those deals almost right out of the gate are going to be 4% less, or at least give us an opportunity to offer 4% less, let's say on a per square foot basis, and get a property that way. So that's another opportunity. And again, it's, you have to understand the entire market. So this table shows the 14 largest municipalities in Orange County, sorted by population. This list is not sorted by population. It's actually sorted on the far right. And again, you can't see the label because the video feed of me is blocking it, but that's price per square foot. So you can see that the most value, the most that you're going to get for your money, let's say the cheapest, I hate saying that word, but it's true. The cheapest property in Orange County is in the city of Anaheim. And then Santa Ana, they're very close, 589, 599, rather 587 and 597, just $10 apart. And then Orange is right after that. Now, by the way, those are fantastic. Like, I don't want you to interpret me as saying those aren't great. These are great cities. In fact, all three of them. Anaheim has amazing neighborhoods, especially by the packing district, I think it's called. Unbelievable neighborhoods in that area. Then there's Santa Ana, which has amazing. Orange, I love Orange. I absolutely love. I think it's a great city with the Circle in Orange and all the restaurants. I think it's a great place. You get a ton of value. But then you can see, and understanding the market is important for you as a buyer to be able to look at Orange County and say, okay, where am I going to get the best value? Like, you might be targeting a particular school district, or maybe you have family in the area, or you want to be near friends, or a particular part of Orange County. But it's still insightful to see the broader picture of where the prices are across the entire county, and where you want to position yourself. And you can see as you get lower down the list, those are the more expensive on a per square foot basis. Those cities are more expensive. So Irvine is more expensive, and Huntington Beach and Costa Mesa is quite expensive. And of course, Newport Beach is unbelievably expensive. It's almost twice as much as Costa Mesa, which is in second place. So if you want to live in Newport Beach, it's a spectacular place to live. I actually live in Newport Beach myself, but you pay a heavy premium to be in Newport Beach. But in any case, that's the whole leveraging the market as it is today is built on understanding the market. So number two in our analysis today is to leverage your lender. This is your unfair advantage. Knowing a good lender, having a good lender, and knowing how to leverage the capabilities of your lender have just unbelievable upsides for you financially. Uh, so the process of getting qualified for a mortgage, there's basically three levels. You can get just pre-qualified. That actually means nothing at all. It means it has no value at all to be pre-qualified. The next level up is kind of the standard. You're pre-approved. Most people get pre-approved, and we're going to talk about the differences in just a second. But this also, you're missing the biggest opportunity. The biggest opportunity is to get a fully underwritten DU pre-approval. And I'm going to tell you what that means in just a second. But let's start with just the pre-qualified stage. So being pre-qualified, you're literally just having a conversation with a lender. And a pen and pencil and paper, they're writing down some numbers, they're doing some basic math, asking you about your income, asking you about your assets, not doing a whole lot more than that. That's why it's not worth anything, because there's no verification at all behind a pre-qualification. So the next step is the more kind of standard thing, getting pre-approved. And it's certainly a more thorough approach. So they're going to ask for your pay stubs. They're going to ask for your bank statements to have proof of funds, and they're going to pull your credit. So that's real information. And then with that information, they're going to give you a pre-approval letter. Now, pre-approvals are fine. The majority of people, actually, I would say the vast majority of people get a pre-approval letter from their lender, but they're missing the opportunity. And the opportunity here is to get a fully underwritten DU pre-approval. Now, if you're curious what DU stands for, it stands for Desktop Underwriter, which is the automated underwriting platform of Fannie Mae, and Freddie Mac has a similar one. But the DU pre-approval means that they actually fully they put it through underwriting. They ran it through their system. The system kicked out whatever conditions it requires, things that it needs, verification, and they went through the entire process to get fully underwritten. Now, what does that mean? That means that you're starting to look an awful lot like an all-cash buyer. Now, all-cash buyers consistently get 5 to 10% discount. Now, I wouldn't say 10% here in California, but let's say certainly here in Orange County, 3 to 5% discount just for being an all-cash buyer. So if an all-cash buyer comes in with an offer that's, say, 3% less than a traditional offer, which incorporates a loan contingency and the delays associated with that, generally the all-cash buyer can offer 3% less and still get the deal. It's not guaranteed, of course, nothing's guaranteed. But the point is, buyers, or rather sellers, love all cash offers, because what do they really want? And think about this for a second. Everyone thinks, oh, well, they're a seller. They want the most money they can get for their house. And yes, that's true. But that's not the only thing they want. They want certainty. They want certainty. People hate uncertainty. Human beings hate uncertainty. So this is a picture of the stock market in April of 2025, and we had this big giant sell-off. So what happened in April of 2025? Well, that's when Donald Trump announced his tariffs. And that represented a huge amount of uncertainty. And we had this enormous sell-off. And at the bottom of that crash, people were selling 21% less because they were so desperate to get out of uncertainty. They wanted to get out of uncertainty, so they sold at a discount. In the stock market, it was a 21% discount. Now, I'm not suggesting there's going to be a 21% drop in home values because of uncertainty, but there's no question that sellers want certainty and they are motivated to accept a lower price to get out of their uncertainty. And having a fully underwritten DU pre-approval provides some of that, because so this is the RPA, this is the residential purchase agreement. This is the form that we use to submit an offer on a property. So if we did this together, we would fill out this form when we're submitting an offer on a piece of property. Now, I've just put dummy information on here, so none of the information that I've entered means anything. But this is the first page of the RPA. And on the second page of the RPA, there's all these fields that we can fill out as part of the offer. And what you'll notice here in the center column is this is the area where you can specify how many days you want to release certain contingencies. And you can see that the contingencies, you can see them along the left-hand side there. There's the loan contingency and the appraisal contingency and the investigation of property and information access and insurance and the preliminary title report. These are all uh, areas where we have, as buyers, we have an opportunity to say, okay, we will release these contingencies after 17 days. See how it's all pre-written. The form is pre-written with 17 days, and 95% of offers leave these as is. They don't change it. And that's a huge missed opportunity. So say, for example, the loan contingency, instead of 17 days, let's say we changed it to just 7 days, right? We don't need, or maybe 8 days or 5 days or 10 days or whatever we need, but we don't need 17 days, right? And we can do the same thing for the appraisal contingency. If we have a good appraiser who's on the ball and quick, then we don't need 17 days to get the appraisal. It's the same thing with the title report. We don't necessarily need 17 days to pull the title report. So what are we doing by entering a fewer number of days into the offer? We're providing certainty. We're providing certainty. Basically, we want your offer on the property to look incredible in every way except price. Except price. We want to offer low and have everything else be so good that the seller accepts your offer over somebody else's offer. That's where you save, let's say you save 2% on $1 million property. That's $20,000. It's a huge difference, right? In some cases, it can even be more than that. So you never really know because you can't split test these things. You can't do it one way and then go back in time and then do it the other way and compare those two. But if you look statistically across the board, if you can provide an offer, that has these fewer contingencies or shortened contingencies, you can get a better deal on the property, right? If you have a good lender and if you know how to leverage a good lender, right? These things are available by having a great lender. Another opportunity is bridge financing. And this is huge. If you have a home that you're currently in that you need to sell, and you want to sell your current home and buy a new home, you need to know about these are unbelievable programs where you can get a bridge financing program where you can write a non-contingent offer, right? In other words, buying a new home is not contingent on the sale of your current home. And by the way, especially in today's market, because 75% of the properties are sitting on the market for too long, sellers hate these types of contingencies where they want to buy your house, but only once their house, because you don't know how long that's going to be. Some of them are going to be on the market for 40 or 60 or 90 days, right? So those contingencies really hamper your ability to get a good property on the next one, whether it's maybe you're buying into a bigger home or maybe you're going into a smaller home, downsizing, whatever the case may be. With a bridge financing program behind you, you can make a non-contingent offer because they will give you 75% LTV, that's loan to value, on the old house, the one that you're in now. They'll give you 75. Now that means that you need to have at least 25% of equity, right? Let's say 30%. They usually have a minimum of 30% equity. So what the house that you're in is worth today, and then compare that to the loan amount that you still owe on the property. If you have 30% of equity or more, then you can use these programs. They will give you 6 months to sell your home, and there will be no payments during that time on the mortgage on your current home. In other words, you can qualify for the new mortgage for the new property without even considering the mortgage you currently have, right? They will let you qualify without that payment because there are no payments with a bridge financing loan. What does that mean? That means you can buy before you sell, right? This is huge. This means you have no temporary housing costs, right? You don't have to move into a temporary place in between selling the current home and buying the new home. You don't have to go through the headache. There's all that. You don't have to carry two mortgages at the same time. You can do the whole thing using a bridge financing program. Now, those programs have fees associated with them, and it generally works out to, it's usually between 2 and 2.5% of the property, but that's a massive savings over trying to do it the other way, trying to carry two mortgages at the same time, or selling one property and renting a place for 2 or 3 months and then buying another place. Those options are really, they're a headache and they cost a ton of money. These financing programs, bridge financing programs are incredible. And that's another thing that's available when you have a good lender, right? And you know how to leverage your lender. This is what I work on all the time with my clients, is how to do things the most efficient way possible. There's a 2-1 rate buy down. What's a 2-1 rate buy down? I'm not going to go into all the details, but basically you get 2% lower interest rate in year one, 1% lower interest rate in year two, and then your regular market rate only kicks in year three. And that makes a huge difference. So if you assume that you're buying a home for $1 million, because pretty much every home in Orange County is over $1 million anyway. And let's say you're putting 20% down, which is 200,000. So we're talking about an $800,000 30-year mortgage. And let's say the market rate, it's just an example, is 6.5%. So at the 6.5% rate, the monthly payment just on the principal and interest of your mortgage is over $5,000. But with this program, it's $1,000 less in the first year. That's a big difference, especially when you're first buying a property. There's always expenses. You have to buy things. There's things you have to set up. Maybe you're buying new furniture. There's always expenses when you buy a new piece of property. So having this allows you to have a bit of savings on the mortgage payment so you can spend money on other things when you're getting the house set up. So the question is, how much does this cost? Well, it's just prepaid interest. So you have to check with the lender, of course. This is not a fixed number. It depends on the market rate, and every lender has different fees that are associated with this as well. So you have to check. But I did it with this particular example, and it worked out to just over $18,000, which is less than 2% of the sales price of a $1 million property, right? Which is not a lot of money. And the whole, what I'm suggesting here is not necessarily that you pay the $18,000 to have a lower payment for the first 2 years, but maybe we can get that as a seller concession, right? Maybe we can incorporate that into our negotiation and have the seller pay $18,000 to give you a lower payment, right? There's all sorts of things that you can do if the same thing is true with a home warranty. Home warranties are like the best deal in real estate. Like, having a home warranty is almost always worth the money you pay for it. It's a very smart thing to do, but maybe we can get the seller to pay for that. I always do that. I do that on every transaction that I do. And the reality is that no seller will turn down an offer for only the reason that we want a home warranty. No seller will do that because it's just not a big deal, right? They might say no to the offer for another reason, but they're not going to say no to the offer because we asked for a home warranty. So I ask for it every time and we get it pretty much again, nothing's guaranteed, but it's an easy one. This is a laydown. It's so easy to ask for this and get it. And these are the things that a strong agent will help you get, right? This is how an agent can help you save money, is by doing these sorts of things, right? Obviously, you have to have strong financials. Just as a general, I had to put this slide in here just to give you the overview of what you should work on and what you should target in preparation for buying a new piece of property. Let's get your credit score up to 720 or higher. It doesn't need to be 720. It can be probably 650 and you're fine. But honestly, all the best programs, the best rates, everything that's good in real estate is going to come if your credit score is above 720. So let's work on that. Get your debt to income ratio down below 36%. I know that's tricky because property is so expensive here in Southern California, but that's the best number to have. Secure your DU approval early. This is going to be the first thing we do if we work together. Is I'm going to set you up. I've got a great lender. In fact, I have two, but one, I just love her. She's fantastic. Anyway, we have to get the DU approval quickly and have it ready to go. Maybe you don't want to buy for another 3 to 6 months. That's fine. It's fine. I'm not trying to rush you into buying a piece of property. I'm never going to rush you. It doesn't matter to me if you do it now or 6 months or a year from now. It doesn't matter. But what does matter is I want you to have a loaded gun. I want you to have everything ready to go so that when the time is right for you and we go out and look at properties and you're going to see something that you love, then you can pull the trigger and we can submit an offer. So getting a DU approval early is a huge piece of that. And again, I'm going to advocate for you doing it as soon as we connect with each other and have a call or meet in person. I'm going to get this process in motion. And then finally, get your bank statements, your proof of funds ready to go so that you have the paperwork. You can give it to me if you want. You don't have to, but we need to have everything in one place so that if you find a property that you love, something that here's the number one mistake that I have to avoid as a real estate agent. You can't miss an opportunity because of me. It can't be my fault that you miss an opportunity, right? This is critical. I'm a real estate agent. So if I let one of my clients miss an opportunity and it's my fault, that's the worst thing that I can do as a real estate agent. So I have to make sure if I'm doing my job, I have to make sure that you're in the strongest position you can possibly be in and that you are ready to rock so that if you find a piece of property that you love, we can submit an offer and we can get you that house. That's my goal. And so I'm going to advocate for getting the DU approval quickly, early, and have those proof of funds, the bank statements, have it ready to go. Maybe it's a bunch of PDFs that you have on your computer. However you want to do it is fine, but we need to make sure that we have everything ready to go. And all those things are possible if you have a great lender and if you know how to leverage your lender. So that's number two, know how to leverage your lender. Let me ask you, you're still watching this video. I appreciate your time in watching this video. Who do you know that needs this information, right? You're watching this video, all this stuff that we're covering. You're probably thinking, oh my gosh, I have a sister or a cousin, or maybe there's a friend at work and you're thinking, gosh, that person needs to watch this video as well. Please pass it on to them, right? Please send them to me. This QR code will get you my contact information. I'll pull it right into your phone. You can get all my contact information, including my private cell phone number. If you're watching this video and you know someone else that needs to hear this information, please pass it along. I do a great job and I love it and I appreciate the referrals. Okay, number three, selecting a strong agent. So look, is this self-serving? Of course it is. This entire video is self-serving. I use this video as a way to meet clients. I meet my clients by having this video out on YouTube. So of course I'm promoting myself as a real estate agent, but this is such an important piece. Your agent is your profit partner when you're going out and buying a piece of property. They can, if they're good, if they're strong, if they're knowledgeable, they can save you money and they can get you a better deal. And that's that's the entire objective. And this statistic is just mind-boggling to me. But 49% of real estate agents have done 0 or 1 transaction in the past 12 months. That's insane. That's insane. And you don't want to be with someone who's not active in the industry. You want someone who understands the marketplace. They understand Orange County and what's going on in the real estate industry. They understand value from one municipality to the next. They understand the ins and outs of real estate and how to get a good deal, right? They understand that inventory is up and there are implications to that, right? There's things we have to consider because inventory is up and it creates opportunities. Don't wait for price reductions. Bid low, right? You need an agent who's got the confidence to bid low. And that's where this research comes in handy. What can we offer, right? What's the minimum that we can offer and still get a counter offer? That's the whole industry on the buy side, is this one question right here. What's the minimum we can offer and still get a counter offer? That is the key to getting a good deal in real estate. And that has a lot to do with the agent and the research that the agent does, right? And I'm going to get on the phone with the listing agent, the agent of the seller, and say, okay, where do we need to be? Right? Is there a magic number that's going to make this work? That's a huge part of my job. That is to get on the phone with the listing agent and say, here's the situation. We want this house, right? Maybe it's tight. Maybe we have to do some juggling, but what do we need to do to make this work? And if you have an agent that has the confidence and the comfort level to make that phone call, it's amazing how the agent on the other side, who is probably someone who I already know, because I know a million agents anyway, the agent on the other side is going to say, I appreciate that Patrick, in this case, me, that Patrick called and was so candid and upfront about the situation he's dealing with. They want it to work with me. They want it to work. And it doesn't always work. It doesn't always close. Maybe they pick someone else, someone's way higher than we are, someone's all cash and higher as well, whatever. But if there's an opportunity where we can squeeze into the property, I can make that happen. And that's a huge part of my job. Negotiation is a critical piece of the real estate puzzle, and you need an agent that's willing to do that on your behalf. So, look, there's a smart way to do this. There's a smart way to do this. So, call me, right? I can help. This is what I do, and I love it. And I so appreciate that you've watched this video and right to the end. Thank you so much. I appreciate it. If you have questions, give me a call, send me a text, scan that QR code. All my contact information is there. And let me see if I can help you buy your new home. Thanks again, and we'll talk again soon.